All right, thank you all for tuning in to WJC LP 98.3 FM Chicago. All right, and welcome to my show, Money Talks, where all we talk is money. Thank you to everyone for tuning in. We're live, right, on the show, Money Talks, and that's every Monday night from 7 to 8 p.m. Central. I won't be here next Monday, because I'll be teaching at the Chicago Urban League. We will be streaming it live, though, so that you can watch it. Right, so we will be live streaming it. But with that, thank you for tuning in to 98.3 FM Chicago. We're live on Facebook and also on Instagram. If you don't mind just dropping in the chat where you're listening from. And then also if you can like and share this video, it's always greatly appreciated. So with that, my name is Jeff Badu, and I'm a parallel entrepreneur and a wealth multiplier. I'm the founder and CEO of Badu Enterprises Llc, which is a multinational conglomerate in the finance industry. And what we do is essentially we provide a suite of financial services, including our marquee company, which is Badu Tax Services, and that's the firm that does tax preparation, tax planning, and tax representation for individuals and businesses across all 50 states in the U.S., and we also have clients in over 25 countries at the moment. Then we have Baidu Investments Llc, which is our real estate investment company. And what we do there is we invest in apartment buildings, mainly on the south side of Chicago, in efforts to restore traditionally underserved communities. And we have Badu Life and Health Solutions Llc, which is our life insurance company that provides life insurance products and solutions to individuals, families, and small businesses. And then for me, none of this would mean anything really without giving back to the community. And that's where we have the Badu Foundation that provides financial literacy education to the youth ages 6 through 18. And then we also teach them on topics such as budgeting, saving, investing, and then scholarships. My purpose in life is to inspire and support the super hungry to take hold of infinite resources in order to create an abundant lifestyle, right? An abundant lifestyle. All right, thank you to everyone for tuning in to WJC LP 98.3 FM. You can also catch us on the website, wjacradio.org, so you can listen live on our website, wjacradio.org. We're streaming live on Facebook and then also on Instagram. And once again, we are live on 98.3 FM in Chicago. All right, shout out to Mrs. CLAVIN. All right. Listening from Michigan, thank you for tuning in. Today we'll be talking about what's been happening with the Biden tax hikes. We do have a tax reform on the floor that's set to be passed by the end of this year. So we will have the biggest tax reform since 2017. I know that wasn't that long ago, but the biggest tax reform since the Trump administration. Expect taxes to be hiked for a lot of people. So we will be talking about the updates. Just came out last week. We'll be digesting it, breaking it down, telling you what it means for in general, and then what it may mean for you specifically. And I hope you're not on the wrong end of the tax plan. All right, so before that, let's just spend 5 minutes. I'm sorry for the late start today, but let's just take 5 minutes to talk about the market report. So we'll start at 7:20 p.m. Central with the topic. We'll start at 7:20 p.m. Central, and we'll go on until about 7:50. So we'll do about a 30-minute or so talk today. Nothing too long, just more of an update for you guys. So solid corporate earnings data last week supported a strong week for equities. All right, investors fears that rising inflation, which is the diminishing purchasing power of your money, supply chain snarls because of COVID-19. Basically, the supply chain has been disrupted in pretty much every industry. And then the labor shortages, people don't want to go to work or they're scared to go to work. They're collecting unemployment. And then the surge in COVID-19 cases would hinder corporate earnings have yet to materialize. So investors were basically afraid that with all these things, right, you have rising inflation, you have supply chain disruptions, you have labor shortages, all right, and then you also have a surge in COVID-19 cases. They were afraid that would essentially negatively impact earnings, meaning that companies will make less money. Well, lo and behold, companies actually made more money. All right, you may not be surprised, but companies actually ended up making more money. So that boosted up the stock market. When investors aren't scared anymore, that tends to hike up the market because that increases demand. More people want to get back into the market, and it creates this whole supply and demand madness. So just something to keep in mind there. The global Dow did dip. All right. The NASDAQ essentially led the way. NASDAQ, of course, is composed of the top technology stocks in the U.S. All right. And then we have the S&P 500, composed of the top 500 companies in the U.S. Then you have the Dow and then the Russell 2000. All right. So last Monday, let's see here, the Dow, basically, it started off pretty good, right? We had good corporate earnings, so everything was all good. Last Tuesday, another strong day. Last Wednesday, stocks fell just a little bit. It fell just a little bit. Last Thursday, another day of strong corporate earnings reports. So you're starting to see this continuous trend of good earnings reports, and then the economy essentially doing pretty good, even though we have all this craziness happening in the world. All right, and then last Friday was a bit mixed, but overall it went up. The Dow Jones so far this year is up 17.03%. The NASDAQ is up 20.25%. 20.25%. The S&P 500 is up 22.61%. Market is up huge. If you're not invested in something right now, I don't know what it is you're doing, to be honest. It could be the stocks, cryptocurrency, real estate, right? It could be whatever, a business. If you're not investing your money right now, you're making a big mistake, in my opinion. You got to get out there and start investing. You can't just have the money sitting in the bank collecting dust and getting eaten up by inflation, which is the diminishing purchasing power of your money. So if you're not investing and you're not able to beat inflation, within a few years, you'll actually lose all your money. That's a serious point. And it don't matter if it's $1 million. You can have $1 million in a bank. That same $1 million will buy less stuff. It will diminish in value, basically, because of inflation, which is when things get more expensive. So these are things you really have to consider as you're going about your wealth building journey and as you're progressing in life, essentially. All right. So just something to keep in mind. Just something to keep in mind. All right. So then with that being said, let's just go ahead and let's see here. All right. So the Russell 2000 actually went up 16.32%. And then the global Dow went up 17.32%. We got one more minute to go before we get into the topic. Let's talk about what's to look forward to this week. The latest employment figures for October are available at the end of this week. September saw 104,000 new jobs added, although the unemployment rate continued to fall, settling at 4.8%. The market purchasing managers surveys for manufacturing and services are also out this week. Survey respondents have noted that supply bottlenecks and labor shortages have hindered overall production. I mean, that was pretty clear, right? It couldn't take a rocket scientist to predict that one. All right, so all that to say, you got to get invested in the market. If you're not in the market, you're making a big mistake. It can be stocks, cryptocurrency. It can be real estate. It can be life insurance. It can be a business. You got to get your money into something. And for me, my top 5 investments, number 1, are business, when you start a business or you acquire a business. Number 2, it's real estate. Number 3, it's life insurance, specifically premium finance, index universal life insurance. And then number 4, you have cryptocurrency. Number 4 is stocks, so equities. And then number 5 is cryptocurrency, which cryptos have been hot. They've been hot this year. Last year, they were pretty hot. The year before, they slowed down a bit. And then a few years before that, they were pretty hot. Bitcoin, by the way, used to be at 17 cents back in the day. And even just a few years ago, it was at about $1,000 a coin. And Bitcoin is shooting up like crazy. All right, so with all that being said, thank you for tuning in to WJC LP 98.3 FM, Chicago. Right, we're live on the radio today on 98.3 FM, so you can literally be in your car right now and tune into the radio. And then you can also listen live on WGHCradio.org. Once again, that's WGHCradio.org. All right. You can also tune in. We're all live on Facebook, and then we're also live via Instagram. So let's talk about the Biden tax hikes. There's 8 updates, 8 things that you want to keep in mind when it comes to the Biden tax hikes. Of course, some of these things may not be the most applicable to you, but I think it's important to pay attention nonetheless, because maybe in the next 4 years, this might be you. You never know. Sometimes you have to speak certain things into existence, or they will never happen, or they'll happen at a much slower pace. All right, so the Biden administration, which are, Democratic by nature, are planning to increase taxes for many people, right? You may not think that it will impact you, but it will affect you one way or another. And it's important to be on the front end, to be in the know of things, as opposed to on the back end, right? So just something to keep in mind. All right, so let's talk about, so these are 8 things to look out for within the new tax plan, which should be passing pretty soon, at least by the end of this year. Right? At least by the end of this year, possibly even this week or next week. So this is serious stuff, right? So number 1 is it imposes a surtax on wealthy Americans. Wealthy Americans. You may not be in that category today, once again, but maybe within the next 4 years. You may be within that category. You may be a 1%er. President Biden's latest Build Back Better plan, so that's the name of the tax plan and the infrastructure plan as well, is Build Back Better. Build Back Better plan settles on a surtax on millionaires and billionaires starting in 2022. The extra tax would equal 5%. 5% of modified adjusted gross income, which is a problem. And I'll explain to you what that means in a second. Modified adjusted gross income from $10 million to $25 million, $5 million up to $12.5 million for married filing joint couples. All right. And then it would then jump to 8% of modified AGI of $25 million. All right. So basically, if you make a lot of money, if you make over $10 million a year, you would have to pay an extra 5% tax. Okay, right? I guess that's fair. It's a Robin Hood method taken from the rich, given to the quote-unquote poor. Of course, I know nobody listening on this channel right now is quote-unquote poor. When they say poor, they just mean financially. Basically, you're in financial distress, meaning that you're literally on the verge of being bankrupt. Like you're one missed paycheck away from being bankrupt. So, and that's what we mean by when we say the word poor. And when we say poor too, we also mean mindset, poor in mindset, meaning you're splurging unnecessarily, right? You're not making your money work for you. You're not investing your money. That's a poor mindset. Technically, you are poor, right? When you have a poor mindset. But when you have an abundant and wealthy and rich mindset, then you will become wealthy financially. You don't have a choice. It will happen, right? So with all that being said, the problem with taxing people based on income is that billionaires and millionaires do not show income on tax returns because they reinvest their money. Billionaires and millionaires know very well you can't have money just sitting. They reinvest their money into income-producing assets, such as rental real estate. When you buy a rental real estate property, you get to claim a tax deduction known as depreciation. And depreciation is essentially, you can claim up to 25% of a building's purchase price. So if I buy a building for $1 million, I can claim a tax deduction of $250,000 just because I bought that building. This is called accelerated depreciation, where we use a strategy or method called cost segregation. All right, cost segregation allows us to speed up or increase the depreciation write-off. That reduces our adjusted gross income. Right? That reduces our adjusted gross income. So with that being said, if we're reducing our adjusted gross income, then essentially, when we reduce our adjusted gross income, that doesn't put us as a wealthy person on paper. Like, you can literally, you might have heard this, Bill Gates, this is well known. He was basically earning $1 in salary. $1 in salary. Where his tax return might have showed just $1, right? He could probably collect food stamps, Section 8, all of that. But of course, this is a billionaire. So the problem when it comes to taxing people, the quote unquote wealthy, on paper, is it will not work too well because the wealthy don't show much money on their tax returns anyway, because they get things like depreciation, right? And then if you invest in oil, you get what's called depletion. These things reduce your adjusted gross income and your taxable income potentially down to zero. All right. So just these are some things that you just want to keep in mind. And that, yes, this will affect some wealthy folks. Now, if you're a millionaire and or a billionaire making $10 million a year, you're probably not going to pay this 5% tax. Let's just be straight up with that. I don't even know why they put this in there. They're saying, hey, you making $10 million, you who've gotten maybe lucky making $10 million a year, you had better get with a tax advisor. You had better get your act together and be smart and use the code to your benefit, right? Don't just sit there, be lazy. Let your money work for you. Or if not, we're going to come take it from you because you're not using it in the best way possible. All right? You're not generating income from income producing assets. And I would say, hey, no fault to the government for wanting to do this. You just got to know how to play the game. That's all it is. If you know how to play the game with the rules that's given to you, then you'll be good. You won't be taxed extra. So that's one thing. Another thing is the expansion of the net investment tax. Starting in 2022, President Biden's plan would expand the surtax to cover net investment income derived in the ordinary course of a trade or business of a single or head of household filer with a modified adjusted gross income of $400,000 essentially. This doesn't really mean a whole lot, but basically, if you sell real estate, if you sell a piece of property, this is more so targeting real estate investors. I don't know why. Right, if you sell property, then you could get hit with a net investment income tax, whether or not it's passive or active. Right? If it's active, meaning you're in an active trade of the business, you can still get hit with the net investment income tax. This is more for flippers, people who flip properties, basically. All right, so basically they're discouraging flipping. That's all it is. They don't want you to be flipping properties. Nothing wrong with flipping, by the way. They just don't want you to do it. That's all. All right. And then the third one is permanently disallowing excess business losses. Now, I think you need to pay attention to this one if you're a business owner, because this one is huge. So this basically, there's a business limitation rule that is currently set to expire in 2027. The president wants to make it permanent starting in 2022. The president's plan would only allow excess losses to be treated as a deduction for the next tax year. According to an earlier summary of the proposal, 80% of the effective business loss deductions will go to people making over $1 million, essentially. So this one is not as crystal clear as you would like it to be. But basically, they're saying you can't use losses that you generated in a given tax year to go back in time and offset income from previous tax years, right? And then potentially you can't use losses in your business to offset income from other sources, right? And so this one is big, right? This one is big. This one is big because they're saying that if you had a W-2, for example, and you made $50,000 and then you drove Uber and, all you were doing with that car was driving Uber, so you got a $20,000 depreciation tax deduction. What I'm reading here is that you can't use that $20,000 Uber deduction to offset your W-2 income. Right now, you could do that. So your taxable income would be $30,000 instead of $50,000. So under this plan, they're saying that you wouldn't be able to do that. You wouldn't be able to use essentially losses from a business, right? You wouldn't be able to use excess losses from a business to reduce your taxable income from W-2 sources. So what is it saying? Become a business owner. Get rid of that W-2. Of course, it's easier said than done, but find a way to do it. Get rid of that W-2 if you have a side business and you have a loss. Right? They don't want people to just be running hobbies, basically, is what they're saying. Where they'll start a business, all of a sudden it's generating losses, right? And it's abusing the rules. And then it's offsetting your W-2 income. Instead, what it could do, if you have multiple businesses, is one business loss can offset business losses from other businesses. All right, so let me read it one more time so you can fully understand it. This business loss limitation rule is currently set to expire in 2027. All right. However, the president wants to make it permanent starting in 2022. The president's plan would only allow excess losses to be treated as a deduction for the next tax year. Now, that part they need to clarify. Right? Excess losses to be treated as a deduction for the next tax year. So that one, they need to provide more clear guidance on, because it doesn't exactly make sense. What I'm reading is that if you have a loss in your business, you can't use it to offset other sources of revenue, W-2 revenue at least, not other sources of business revenue. I would hope they're not talking about businesses, right, when you own multiple businesses. I would hope they're just talking about just the W-2 side. All right, so that one, I'm sure they're going to battle it out, clarify it as much as possible. All right, by the way, thank you for tuning in to WJC LP 98.3 FM Chicago. You're listening live on the radio on 98.3 FM. You can also stream it live on WJCradio.org. And then we're live on Facebook and on Instagram. You can feel free to drop in the chat any questions you have. Please like and share this video. It's always greatly appreciated. All right, so let's get into some more stuff. It extends the Earned Income Tax Credit. In a nutshell, the EITC Earned Income Tax Credit improvements for workers with no qualifying children that would be extended to 2022 include lowering the minimum age from 25 to 19. Right, so the minimum age to get the Earned Income Credit would go from 25 to 19. All right, except for certain full-time students. So they understand that people are starting to work earlier now. It eliminates the maximum age limit, 65, right? This is that Social Security scam that they're talking about. So older people who don't have kids can now continue to work and slave for the rest of their lives and get the Earned Income Credit. It's incentivizing more older people to go back to work, right? And not collect their Social Security, which may not be around when they want to collect it anyway. It increases the maximum credit from $543 to $1,502 for the 2021 tax year. The maximum would be adjusted for inflation for the 2022 tax year. All right. And then it expands eligibility rules for former foster youth and homeless youth. All right. So essentially, all right, sorry for the background noise there. So if you have no kids, basically, you can get a higher Earned Income Credit, which is a credit for you going to work, basically. You would also be allowed to base your 2022 Earned Income Credit off your 2021 income. All right. So in case you were affected by the pandemic, once again, sorry for the background noise there. So far, I mean, these are some pretty massive, like, rule changes. Especially that excess business loss one. All right, that excess business loss one is pretty big. That's something we certainly will investigate more. We'll digest it even more because that's big. We have a lot of clients that may be a W-2 employee and have a side business, right? A side business, and we use a lot of tax planning for this. And then who knows? They might even be talking about someone who owns multiple businesses. Can you imagine not being able to use a loss in one business to offset income in another business. I mean, that would be nuts. I would think they would fight that one, right? So we'll definitely investigate that some more, because I think that one is pretty big. And then also this expansion of the earned income tax credit. I think that one is pretty big as well. All right. So let's move on. Child tax credit. Shout out to my parents out there. All right. So this would enhance the child tax credit and also the monthly payments. So here we go with the monthly payments. This will cause some confusion for taxpayers. By the way, you do have to reconcile how much you received in those monthly payments on your 2021 tax return that you file next year. I'll repeat it one more time because this will get missed for a lot of people. Whatever you received in advance child tax credit, the monthly payments you may be receiving in your bank account right now because you have kids, you will need to reconcile it and make sure it's an exact dollar amount that you're putting on your tax return, because the IRS will use whatever you receive, compare it to what you're truly entitled to, and net out the difference. Right? If you receive less than what you're fully entitled to, you'll get a child tax credit. If you receive more, then I don't know exactly if they've clarified this guidance yet, but you may be forced to pay it back. All right, so basically, the Biden administration wants to enhance the child tax credit. It would mean the monthly advance payments in 2022 as well. All right, so essentially, let's see here. The American Rescue Plan, which is the plan currently in place, increases the child tax credit from $2,000 per child to $3,000 per child, right? $3,000 per child, and then $3,600 if your child is 5 years or younger. All right, and so these limits would continue through 2022. However, for the 2021 and credit, there will be an extra $1,000 essentially would phase out for families with higher income. So they're increasing basically, if you have increased income, then the bump up essentially is going to be reduced. All right. So yeah, essentially the increased child tax credit, they're going to reduce it for those who earn higher income. So that's going to bring your credit back down to $2,000 or $2,600 respectively. All right. Actually, no, it would bump you down to $2,000 per child. So if you make more than $75,000 as adjusted gross income, and then $150,000 if you're married, yeah, you're pretty much not going to get that full credit. So maybe something to watch out for. I'm sure they'll clarify that even more. I can see that one passing pretty easily. The one thing I don't think will pass is that excess business loss one. I think we really have to pay attention and be careful with that one, because that can screw over a lot of people. They basically don't want people to be running hobby businesses. They don't want you to be running a hobby. They want you to be running a legitimate, solid business that's hiring people, generating income, and stimulating the economy. All right, so the next one is it extends the premium tax credit. So you can get a credit right now if you have health insurance. All right, you can get a credit right now if you have health insurance. So essentially, the American Rescue Plan, which is the plan currently in place, made temporary improvements to the premium tax credit. All right. And this credit basically helps people pay for premiums for health insurance through the Obamacare, the healthcare.gov. So President Biden's Build Back Better plan would extend, right? It would extend some of the provisions. Essentially, it would it would increase the amount of credit that you're getting, right? So if your income is lower, it would increase the amount of credit that you're getting to the point where you're literally your health insurance could be subsidized in full. All right. For example, it would permit people with an income above 400% of the federal poverty line to claim the credit. And then it would lower the percentage of annual income that eligible Americans must contribute toward their premium. All right. So this one is pretty nice. I really like this one. And then it would add tax breaks for education for those who are going to school. College students would get a few additional tax breaks under President Biden's plan. First, it would exclude federal Pell Grants from gross income. So you no longer have to report Pell Grants as income. And then tuition and related expenses wouldn't be reduced by the amount of any Pell Grant for the purposes of calculating the American Opportunity Credit, right, or Lifetime Learning Credit. Also, students convicted of a state or felony drug offense would be allowed to claim the American Opportunity Credit. So you may remember that you get asked a question on your tax return, hey, are you a felon or are you an ex-felon? Right? Then ultimately, you would, if you check yes, you wouldn't be eligible for the American Opportunity Credit. Another thing it would do is it would improve tax breaks for green energy and energy efficiency. So if you install energy efficiency items in your home, then you would get more of a credit. All right, so this will help solve the climate change problem that we have, global warming that we have in the world, or help solve it. The credit would jump from 10% to 30% of the cost of installation for qualified energy efficient improvements. And then the $500 lifetime cap would be replaced by a $1,200 annual credit limit. The credit would apply to the cost of home energy audits and more. All right. So there you have it. All right. These are 8 things to consider when it comes to the Biden tax hikes, or the Biden proposal, essentially. These are things that you need to be on the lookout for, especially that excess business loss one. That one, I strongly encourage you to pay attention, because I think it's going to be huge. It might not sound big as I'm reading it, but it is something I think everybody should be paying attention to, if and only if you own a business or if you're an aspiring business owner. All right, these other things like the enhanced earned income credit, child tax credit, and then the college stuff, I mean, that's all good stuff. The energy efficiency, that's all good stuff. Things that will only stimulate the economy even more. So the first things that I read, those are the more negative things. And then the last few things that I read, those are the more positive things. Right? The excess business loss one, let's pay close attention to that. And then the tax on the wealthy, I don't think that one is going to affect really anybody. Because the wealthy know how to move their money around. Trust me, they'll figure it out. They'll figure it out. If anything, they'll retire early. Who knows? Let's see. The expanding of the net investment income tax. I mean, that one is going to hurt flippers. So flippers, please watch out. Everything else, I think, is on the up and up. I think it's pretty good stuff. And so with that, if you have any questions, need help with anything, check out my website, jeffbadu.com. Once again, that's jeffbadu.com. jeffbadu.com. Check out the Infinite Wealth course. If you're on Instagram, it's the second link in my bio, the Infinite Wealth course. If you type in the code INFINITE, you get 50% off the course just for listening today. You type in the code INFINITE, you get 50% off just by listening today. So for those on Facebook, just go to jeffbadu.com. There's a link there to access the Infinite Wealth course. And then on Instagram, go to jeffbadu.com or click the second link in my bio and then type in the code INFINITE. The code INFINITE. You get 50% off the Infinite Wealth course. All right. So there you have it. That's the Biden tax plan in a nutshell. The Biden tax hikes. There will be some more stuff coming pretty soon. They will fine-tune everything, and then this will become law probably right before Christmas. Right before Christmas, this will become law, and it will be effective, hopefully, just 2022 and not retroactive to 2021. Because if it's retroactive, then we're in some pretty big trouble. All right, so, and this is all to fund the infrastructure plan, by the way. This is all to fund the infrastructure plan. And so these are things we have to be on the lookout for. As new administrations come in, they change stuff up. They change up the code. They change up the laws. So you always have to be on the up and up. You always have to pay attention and find out what things affect you. Find out what mostly affects you and then the people around you as well. All right, me personally as a tax advisor, I have to be on the up and up on this stuff I have to be on the front end of this stuff. This stuff just came out last week. I was reading up on it, dissecting it. There's still a few things that need to be cleared up, right? But when you're in the know, then you can make smarter decisions early. You can make decisions early. And so I would hate for you to be the one to foot a bigger tax bill next year moving forward. One thing I would advise you to do is get with a tax advisor like Badu Tax Services and start doing some tax planning. Right? Start doing some tax planning, because then we can talk about some of these things, how they will impact you. We'll always talk about the current law, and then we'll run a scenario to talk about the potential future law. And so with that, thank you all for tuning in to WJC LP Chicago 98.3 FM. You can catch us live every Monday night from 7 to 8 p.m. Central on my show, Money Talks, where all we talk is money. You can also go to WGHCradio.org. Once again, WJCradio.org. We are a 501c3 nonprofit organization, so any donations to the channel is tax deductible. All right, shout out to Oshan Walk. Says, we appreciate you. Absolutely appreciate that. I won't be here next week. I'll be teaching the Chicago Urban League from 6 to 7:30 p.m. Central, right? Talking about budgeting and how to get your money right, especially for 2022. That will be streamed live on Facebook and Instagram, so 6 to 7:30 p.m. Central. Next Monday, I won't be here. The following Monday, I will be back, and we'll take it from there. So thank you all for tuning in once again. My name is Jeff Badu, and I look forward to continuously delivering you all some content. Thank you.